Hello and welcome back to the Store Hero podcast. This week we're going to jump into a really, really interesting topic. If you're following us on LinkedIn or have watched any of these podcasts in the past, you've probably heard us talk an awful lot about contribution margin and its use and effectiveness in driving an e-commerce business forward. I suppose the paid marketing spend of any e-commerce business is really the fuel that drives the business, but it can be terrifying to try and increase that spend if you're not fully confident in what it's returning to you as a business level. In the past, I think a lot of business owners probably have utilized ROAS as that primary metric as which to gauge the proxy of the success of their paid marketing spend. But I think as we've all seen in the last number of years, attribution issues, lack of clarity on unit economics and profitability, it's not the guiding principle. We're really trying to figure out, as we look to increase spend, what is the profit after that marketing spend, the contribution margin. So today, as always, joined by Karl, and we're going to jump into a couple of topics, a couple of examples, try and really, I suppose, help brand owners identify where to spot the green flags as much as the red flags, because it can be hard to make sense of all the data and actually make proper decision making of it. So we're going to run into a couple of different topics, and then we're going to give some live store examples here as well. Karl, good to chat.
Good to chat. It's same thing as you said, harping on about this topic for a while now on LinkedIn, so people are well sick of it, but we're going to continue to do it. So that's very much an indication of how important we think this is. So ultimately, I think the way to simplify this is, ultimately, if things are working well, we can set out a clear cause and effect framework. I take X action and I get Y response or outcome from that action. That's a good thing by nature of the fact that you're in control and the levers of your business. And ultimately, when it comes to paid advertising and growth, people often don't feel like they've those levers in front of them. So just to take maybe one example, one kind of key outcome, one key input, I should say, that a lot of businesses would have on a consistent basis is deciding on the level of advertising spend. It makes up potentially a double-digit percentage of their P&L on a daily, weekly, and monthly basis. And ultimately, if that's efficient and working well, then allocated to the right places, you're going to see the benefit of that in terms of the overall sales and profitability of the business. If it's allocated incorrectly, that can really suffer. And that's where a lot of fear and a lack of clarity can come from, around not really knowing, do I have full control over those levers in the business? If I spend an extra euro, pound, or dollar, will that go not only to drive additional sales, but will it drive incremental profit?
I think that's such an interesting point, just to jump into that as well. It's such an interesting point because I think too many brand owners, and we see it all the time, are too overly fixated on top line revenue as opposed to actually understanding, has extra incremental spend not just driven extra sales, but actually driven extra profit. And they're two very different things.
Definitely. And I suppose this is really trying to hone in on there's never going to be one metric that's going to really guide your overarching business, but how can we ask a more precise question in order to get a better answer? So instead of wanting to just grow the business, how do we want to grow it profitably? And that as a caveat that people always have at the end of the sentence these days versus maybe a couple of years ago where it wasn't as much of a consideration. It didn't need to be as much of a consideration. So just maybe to kind of illustrate this point, if it's a case where we want to know, for every additional euro, dollar, pound spent, does it drive incremental profit? Contribution margin is the metric we're using as an indication of that. So ultimately, contribution margin, for anyone who's not certain, is going to be your gross profit after marketing costs. So that's going to be your product cost, packing, shipping, transaction fees, discounts, returns, and then that advertising spend. The benefit of including advertising spend rather than just using gross profit is you could have fantastic underlying margins, but spend a considerable amount to actually get that sale over the line in the form of paid ads. Truly, while it's not treated as a variable cost, your paid advertising spend is very variable. And it's not something you can guarantee to be consistent as you might have your product cost. If your product cost changed as much as your ad spend, you may shut up shop. That wouldn't be a good business to run. So ultimately, on that basis, what we're saying is, if we spend more or less on ads, what's the implication on contribution margins? So we try to bring these back to kind of 4 different scenarios. So if you spend more on ads and your contribution margin or your profit margin or your profit after marketing goes up, that means there's more profit being thrown off each of those orders, and therefore it was worth spending more on those ads. And we can go through an example of that in a second now, and a couple of examples as to how to identify that and spot which kind of quadrant that you're in. Now, alternatively, there's a couple of other scenarios that you may want to look at, or you may actually experience yourself, and it's worth studying, I suppose. If it's a case where your ad spend is rising and your contribution margin is falling, that says that any of that incremental or additional ad spend has resulted in less profit. Those additional orders have been margin losing rather than margin making. It's actually eating into that profit pile, let's say, and therefore you potentially, again, every scenario is slightly different. You potentially may not have been worth spending that additional incremental spend. Now, you could have other scenarios there where maybe your ad spend goes down and your contribution margin goes up. So in that situation, okay, well, realistically, you may have actually reversed the negative trend there. You may have hit a ceiling and you're pulling back a little bit. So therefore, you're in a better position from a contribution margin perspective, which is great. And then finally, there is kind of the last component of the quadrant here is when your ad spend goes down, but your contribution margin goes down. So what that often is an indication there is you may not actually be investing enough in order to drive the right amount of profit for the business. So again, we'll dive through each of those scenarios in a bit more detail. So first and foremost, to take a look at that first scenario, your ad spend is going up and your contribution margin is going up as well. So let's take a look at a sample business.
And just before we dive into this as well, I do want to point out that we are making generalizations here as well, because there will be instances for every business where the advice we're giving here won't make sense. If you get to January and there's a lot of old stock that you need to clear and turn into cash, that might make sense. If you're a business where the numbers look great here, by all accounts, from a store hero perspective, you should double down on spend, but maybe there's cash restrictions or inventory restrictions, that kind of thing. You need to take this information with the nuance of your own business on board as well. But generally, these principles will apply for any business where the cash position is healthy and you have enough inventory to kind of proceed.
Definitely. And to kind of look at those different scenarios between, you may look to maximize revenue, you may look to maximize profitability, you may look to maximize contribution, new customer acquisition, I should say, or alternatively, you may look to kind of maximize sell-through of inventories. So defining exactly what your target is and to give you a lens to look at all this stuff is going to be a really important factor. So let's take a look at this sample store here. This is a store. So Thomas, if you even want to look at maybe last year to give an indication there.
Yeah.
Perfect. So in this scenario, as you can see, and we can take a look at a couple of different scorecards within the Store Hero platform. So typically you're starting with the overarching net sales number. That's going to be maybe the guiding indication most people would have around the success of the business on a daily, weekly, or monthly basis. So on its surface, great, 33% increase in net sales. The challenge is that net sales value or net sales increase doesn't give us any context on the profitability of that revenue. So ultimately, you could have spent, to drive that million in net sales, you could have spent 10K in ad spend, you could have spent $1 million in ad spend, and that's going to leave you a completely different profitability and a completely different cash position. So this particular scenario there, as you can see, the ad spend of the business over the course of last year, 2023, increased dramatically, 260%. So ultimately what they found is there was a big upfront not even from a cash flow perspective as much, but a big psychological decision, I would say, in order to make a decision to spend a lot more than they typically would. That can often be scary for businesses, especially over the last couple of years where their ROAS has fallen. It's not as clear as to exactly what's that point of maximum profitability. And therefore, to the untrained eye, it may look to actually guide you to spend less versus spending more. So maybe, Thomas, do you want to touch on that?
Yeah, I think it's a bit of a mindset shift for a lot of brands, because you're actually, I think a lot of brands in the last couple of years, and for good reason, you've been focused on trying to gain maximum efficiency, but there's a balance to be struck there. You can be the most efficient brand in the world and spend €5 a day on Meta, and you probably get a 20 ROAS, whatever it's going to be. But you're not going to scale a business trying to keep that ROAS as artificially high as possible for the sake of efficiency. So there's a balance to be struck there between, what's the max MER or marketing efficiency ratio we can get. So essentially net sales divided by total marketing spend, where it makes the most sense from a profitability perspective. And I know for this business in particular, as you kind of alluded to there, it was once they had all the numbers in front of them and they were very, very clear that the extra spend was actually yielding extra contribution margin or profit here, that actually allowed them to do this, because inventory and cash weren't an issue here. It was more of a psychological kind of breakthrough, as you mentioned there. So as you can see there, a 260% increase in spend coupled with a 56% drop in MER in the business owner's eyes in January of last year wouldn't have really made any sense. It would have been an illogical position for the business to take. But as you can see there, they've really bought in, and I suppose using contribution as that North Star metric. The contribution margin or profit after marketing spend did rise by 18%. And again, as we can see, contribution margin rose by 18%. The fixed operational expenses of the business, I think, if I'm not mistaken, dipped slightly by 2%. But that just meant that, overall, the net profit of the business rose by 35%. Do you want to just explain the difference between contribution margin and net profit there, just to kind of double click on that one?
Definitely. So ultimately, the way typically we would think about contribution margin, again, that gross profit after marketing, is ultimately, marketing costs, your ad spend, often may be coupled within your, the operational expense line of your P&L. But practically, it's less of a fixed cost. It's not a fixed cost per se in the context of e-commerce businesses, or it is a lever that you can pull. So ultimately, what we're saying here is, okay, what is the profit that each order or your orders are contributing to your business contribution margin? And therefore, if you have that profit after marketing, all that's left, I suppose, is to look at your operational expenses, take those away, and then at that point you're ending up with your net profit. So the whole concept here, rather than traditionally looking at just what would usually be considered gross profit and net profit, is we're pulling out marketing and treating that as a kind of an interim place between those 2 points, and that's really contribution margin. So again, treating ad spend as a variable cost nearly, in order to know, okay, at the end of the day, after that investment I've made in advertising, am I in a better position? So in this scenario, what we're really saying here overall, this business spent a lot more. They could afford for their marketing to become 56% less efficient, which again, if you're just looking at your ROAS or just looking at your MER, doesn't look like it's the right way to go. But it's not about, again, maximizing your ROAS. It's maximizing your ROAS as you scale your business. Because again, you need to make sure there's enough efficiency within your ads and to allow you to actually spend more and end up in a position where the actual contribution margin, dollars, pounds, or euros in the business are actually left, to its best an extent at the end of the day. So again, just to summarize that, so our net sales are up, our contribution margin, despite the fact that our ad spend has increased dramatically, our contribution margin, our gross profit after marketing, is still in a better position. And I suppose that's what we're really trying to encourage people to use as a better North Star, not the only metric to look at, but a better guiding light in terms of actually running the business with a profit orientation.
Some other, I suppose, key points there as well to kind of touch on that, spending so much more extra money on marketing for the business just allow them to grow that new customer base substantially. Again, I do want to point out that this business probably was underspending substantially as well last year, because despite a 56% drop in MER being your net sales divided by marketing spend, it was still 7.59, which is still really, really high. But yeah, just spending so much more did allow them to grow top line sales, but it did allow them to grow that new customer base as well. And they do have a strong LTV, which just means everything else is just going to make the overall unit economics of the business much clearer. I think we might even jump here and have a look at last month and just kind of really, I suppose, jump in and try to illustrate the point between increased spend and contribution margin here again. As long as your contribution margin is positive, it's generally a good thing. We might touch on that now here again.
Definitely. So again, look at that scenario again. So ad spend goes up and contribution margin goes up. This first component of the quadrant versus last year is a really positive sign. So despite the fact I've invested more, despite the fact that my efficiency isn't as high, I've ended up with more gross profit after marketing, driven through the business, which again, as we said, should be a better indication, a better North Star at the end of the day. So again, as you can see here, there's a combination between a couple of different factors. Small improvement in your gross profit. So that was driven by and an equally kind of comparable decrease in the cost of goods percentage of the business. So that may have been driven by pricing changes, by slight differences in the products that people purchase. Maybe they purchase more higher margin items. So that had a nice contributing factor. The fact that we spent a lot more from there. And then from there as well, some small savings in the operation expenses all contributed well. And I suppose just to touch on that point, and again, an illustration why no number is going to be the complete panacea, the only thing to look at. Again, this is all being done even while growing the new customer acquisition. Oftentimes it may look like you need to have a trade-off between short-term profitability and long-term sustainability of the business through acquiring new customers. That's also a balance you want to find, and therefore every single thing that we say in this episode and I suppose try to educate and can give people context on in all of our content. It all has to be taken into account. The broader business needs to be taken into account as well, making sure you're very clear on what's the finish line you're aiming for yourself and operating in that direction as well.
Yeah, I think this business's primary goal for this year is they're quite Q4 heavy, like a lot of e-commerce brands. And the primary goal is to maintain relatively similar profitability levels to last year on a contribution basis, and try and scale the ad spend in a way that they can grow top line sales, grow that new customer base at a relatively similar level to last year, and then hopefully capitalize on that increased LTV as we kind of come towards Q4. So I think it's a really, really sensible strategy. But I mean, this is a good one. We're going to move on to another business now, I think, which to me represents the greenest of e-commerce flags. And what do I mean by that? I mean, I had called this brand probably at the end of January, I think, and we're looking at year over year here now. Just to kind of point out, I suppose, some maybe structural changes that the brand made that maybe led to some of the green flags here. Gross profit increase. I think they made a big pricing increase on their hero products. They actually carried out a hell of a lot of CRO conversion rate optimization exercises on the website, and really saw no decrease in spend in conversion rate. I actually think they saw a conversion rate increase despite a large price increase as well. So you've got those two amazing kind of things coming together there as well. Obviously increased margin from increased prices, and then increased conversion rate on top of increased prices. So the business's gross profit margin increased substantially. So that allowed them to spend more. So looking at January, again, this is year over year, they saw 78% increase in spend. Good increase year over year in spend. Net sales up by 56%. Okay. But, and this is what I was a bit of a wow moment when I saw it, I suppose, the first time. Spend was up by 78%, but contribution margin, the profit after the marketing spend, was up by 102%. So what that really means there is they've risen sales ad spend by almost 80%, but the contribution margin, the profit after marketing spend, has actually gone up over 102%. So in the previous example there, we saw the brand, just to jump back to it really, really quickly, the brand increased spend by 67% with a 4% uplift in contribution margin. That was positive because they spent more and they generated more and more profit. In this case, the brand year over year increased spend by 78%, but the profit after marketing spend was positive, and it was actually rising at a faster rate than the ad spend. So, I mean, I had a chat with the guys that had said, look, I think there's a really, really good opportunity here in front of you. The new margin structure of the business, I think, is lending itself that you guys can spend a hell of a lot more on marketing. Again, they were fixated on trying to hit that 3.2 mer position. And what we'll see then in February, they actually went ahead and did double down and did kind of take a swing, a much higher swing. So just to kind of double click on this, so they have $169,000 in contribution margin on a 160K spend. Whereas when we jump into February, we can see the big jump here now. So we're just going to go and look at February year over year. And we can see the spend went from 160K up to basically 260K, and the contribution margin jumped substantially there as well. So even despite a big increase from January to February, year over year, like you remember in January there was an increase year over year of 78%. In February, there was an increase of 186%. So again, big increase on February year over year as a result of the strong performance in January. And we can see there that in January, there was an increase of 68% on spend, and contribution margin rose by 102%. In February, again, we can see these two are pretty much tied very, very close together. So, spend up 186% year over year, and profit after marketing contribution margin up by 180%. I had a chat with these guys again the end of February. I said, I still think you need to take a much bigger swing here again, because again, as we can see, as long as contribution margin is positive, you should continue, and you have the inventory and the cash to do so. That's a really, really important point. As long as your increase in ad spend is yielding extra contribution margin, that's a positive. You should continue to spend. But it's very, very rare you find positions where your ad spend, despite a large rise on the previous month, is still in or around the same percentage increase on a profitability level after that ad spend again. No, again, I think this brand has a lot more room to push just as a result of what we're seeing here in front of us. As we can see, they spent a hell of a lot more. And as you'll remember, in January for this brand, they were at a 3.2 mer. So despite a substantial increase in spend and a 14% drop in mer, the contribution margin dollars that they generated went up substantially there. So I just think that's such an important point. I think month over month there's about a 70K increase in contribution margin, which really just changes the whole business.
Definitely. I think really the key outcome we would see here, and it's really the thesis as to why we started Store Hero, is because if you're trying to make these decisions and, increasing your spend by 2-3x just purely on using net sales as an indication, that's a very dangerous game to play. And it was only because the brand had the certainty of seeing that contribution margin, that growth for the profit after marketing costs, that they could afford to make a decision to make such an investment, because ultimately they know they're not digging themselves into a hole by spending through a net sales lens, ending up in a position where you may have a really nice kind of Shopify dashboard screenshot. Your top line sales are really strong, but ultimately it's come at a very high cost, and potentially a cost that puts the business in a difficult position otherwise. And as we can see here, even if we just take the February statistics, 750K in net sales, it's no easy feat, and it's an incredible testament to the brand and the team for the hard work they've put in to date. And ultimately, what this ultimately allows them to, what the increase in ad spend allows them to do is realize extra profitability from all the hard work they're putting in anyway. They're making the hard decisions in terms of pricing changes, conversion rate optimization, product mix, whatever the case may be. And simply to kind of actually put the foot down when you've an opportunity to, that's something you want to know about and want to make a decision on the back of it as well. So
yeah, I mean, it's such a positive for this brand. January they were really, really happy with it, and they were hoping to do in or around the same for February. But as we can see here, like February's profit is up 40%. Profit after marketing spend is up 39% month over month. Ad spend up 61%. They were hoping to keep spend actually a little bit less for January, before we kind of had that debrief, I suppose, at the end of January. With the shorter month, 31 days in January, 29 this year with the leap year. So they spent a hell of a lot more in February than they did in January. Profitability after marketing spend up substantially. And even new customer growth there, up 58% month over month, which is just incredible. So I think they had to go and readjust the rest of the year's figures in terms of their forecasting, because they're set to blow it out of the water by all accounts, which is fantastic. But I think to your point as well, yes, absolutely. You can talk about contribution margin. We're all lost in a world of acronyms when it comes to e-com marketing and finance on a daily basis. It's trying to understand what are the best decisions that I can make that reduce the risk levers. And there can be waste on both sides. I think when it comes to marketing, there can be waste on that you've overspent on your marketing budget and you're driving top line revenue, but it's coming at the expense of profitability and it's not planned. But on the other side of it, and I think this happens more businesses than they actually probably even know, often there's a bigger opportunity in front of businesses. And when it comes to waste on the other side, what am I talking about? If you have inventory and you have cash in the bank and the unit economics are actually staring you in the face of your business, you could be leaving the cash in your bank account sitting there doing nothing for you, instead of actually investing it in your marketing spend. And why do businesses do that? Genuinely, I think most businesses are still in a position where there's too much ambiguity, too much mess between the finance department and the marketing department on actually how to drive clear, profitable growth. They're not aligned on contribution margin. They don't clearly understand how the two interact with each other. And I think if more businesses understood this, they will be able to spot the green flags as much as the red flags much quicker. And I think everybody would be in a much better position in terms of understanding the true health of their business.
Definitely. I think it's ultimately, having more signal than noise is really the goal, and it's often the opposite in other situations. So maybe even just to take a step back there and look at the other kind of core components of the quadrant that we can pull up on screen. So ultimately, these are the scenarios in which ad spend is rising and contribution is also rising. We saw a situation there where ad spend was rising quicker than contribution margin, but as long as that contribution margin was still up, then we're in a better position. Alternatively, with a second situation there where ad spend went up and contribution margin went up to a greater extent. So again, with all those other business changes in mind, we not only raised our ceiling, but we allowed the ceiling is rising quicker than we're spending, which is a fantastic position to be in. So to look at those other scenarios then that might be a situation that you want to dive into and maybe a reality in your business. If your ad spend is going down and your contribution margin is going up, so what that is telling us is that the profit after marketing is increasing when you spend less, and therefore maybe that's additional spend that you were spending and wasn't being done profitably. Again, this is with some important caveats that it may be wise to make a forward-looking investment to acquire new customers if that's a key prerogative of the business, and whether you're a once-off purchase or alternatively a subscription purchase. Even that point may stand even stronger when you have a certain guarantee or a certain expectation that customer will come back. So again, in that scenario, all those kind of caveats and that important context aside, if ad spend is going down and contribution margin is going up, you may have actually reversed the negative trend. So I suppose ultimately, to give yourself room to spend more profitably, ultimately what you want to do is raise your ceiling. So continue reviewing your funnel for areas to improve your customer acquisition cost, or you get that down, or increase your AOV, so you can actually, rather than necessarily assuming or expecting your CPA to fall, giving yourself more room to spend a bit more profitably or more profitably than otherwise is a big factor. Thomas, how have you found that, I suppose, in actual maybe real life case studies and user stuff like that?
Yeah, I mean, I think the two examples we just went through there just really illustrate all the key points we just touched on there. But it's so important, and I just think that even I think a lot of the best agencies are probably moving towards this now. I think we've onboarded agencies in the UK, the US, Canada, and Australia in Q1 of this year, and I think the initial feedback has been that the clients love it and that the clients are now getting full reporting on what actually matters to them. I think there's a big shift coming in the agency space where agencies are going to report directly to brands on what actually matters, profit. Every business is set up to generate a profit. It's every business owner's prerogative when they go to an agency to try and use that agency to drive more sales, but really to drive more profit. And if the reporting mechanisms don't take that kind of profit contribution margin into account, you can get lost in a sea of metrics, and it makes it really, really difficult to make easier decisions on, risk levels, that kind of thing as well. So I suppose broad strokes, what we're trying to do here is help businesses identify when the red flags are there, when the green flags are there, because often those signals can get lost in a sea of noise, and it can be really, really difficult to truly understand what's working and what's not working for your business.
Definitely, and as you said, ultimately there's a statistical approach to this whereby we can see the direction of a number of different metrics, but more broadly, we're talking about more clarity in knowing what the true levers are within your business, and more confidence to actually make decisions off the back of that, because you have an opportunity to see that number and it's not a guessing game, which is a much better position to be in. So again, hopefully this has been beneficial for everyone listening. Again, we're definitely looking to we won't be stopping harping on about contribution margin anytime soon, so expect more in this vein to ultimately do what we can to kind of push a profit first e-commerce message to kind of give people a better tools in order to make decisions through the lens of profitability. So thanks again. If any questions, just let us know, and hopefully speak soon.
Cheers.